we are in a different environment than what we've experienced over the past 15 years.
It began with decisions by the Federal Reserve.
We've raised the federal funds rate by 500 basis points since a little more than a year ago. We also think that there's more tightening power coming through.
The speed of this hiking cycle is distorting Wall Street and reshaping personal finance in America.
The Federal Reserve just hit pause on interest rates, and it's shaking up the stock market and housing sector. Is this a sign of troubled times ahead? Let's dive in and find out. Let's talk about inflation. It's this sneaky little gremlin. Well, except it's not little in this case. It's this huge problem that quietly makes everything cost more, and it's playing a big role in the financial world. Recently, prices have gone up a lot, about 3.7% for everything in general. Food got hit the hardest, going up by a huge 14.7% in just 1 year. Other things like salad dressing, uncooked beef, and chewing gum also got more expensive. Even car insurance and renting a home got pricier by a lot. Like car insurance shot up by 19%. Gas for your car went up by 10.6% in August alone. This is the highest inflation rate we've seen since 2022. The Federal Reserve, a group that looks at money stuff, has a way of measuring inflation called CPI. But here's the tricky part. They don't count food and energy prices in this method because they say they change too much. When they used this method, they said inflation was 4.3% instead of 4.7%. It's a bit like doing a math problem, but skipping some of the numbers. Here's a surprising fact. If you take out the cost of renting a home, inflation would be much lower, only around 1%. Some experts say housing costs are a big part of why things cost more. Landlords, the people who rent out homes, are increasing rent prices a lot, even more than what the Federal Reserve expected.
The Federal Reserve has been under the gun since the beginning of the year when it became apparent that inflation was not transitory, not going down anytime soon.
As the Federal Reserve tries to control the situation and keep our economy steady, inflation keeps popping up. It's like a never-ending story. We're all wondering, is this the end of the story or just a really intense moment in a much longer tale? We'll have to wait and see what happens next. All right, let's talk about housing and what's happening right now. So the housing market is going through some changes, and you might be wondering what's causing all this. Well, one big factor is the Federal Reserve freezing rates. This means they're not making borrowing money cheaper or more expensive for now. Statistically speaking, the national housing prices have gone up by about 2.5% compared to last year. Sounds like a small number, but when you add in higher mortgage rates, your monthly payments are now around 19% more than they were a year ago. That's a noticeable increase in what you have to pay every month. The prices are not going up everywhere, though. In fact, 11 states, mostly in the West, saw a decrease in home prices. But don't get too excited because many of these places have a shortage of available homes for sale. So this drop might not last long, and competition among buyers could go back up. One big reason why housing prices are so high is because there aren't enough homes to buy. Mortgages, the loans you use to buy a house, are also more expensive now. It's like a double hit on your wallet. Here's a tip for the future. Because of this low inventory, experts predict that houses might be cheaper in 2024 compared to now. So, if you're thinking of buying a house, it might be a good idea to wait a bit and see if prices come down. In a nutshell, the housing market is changing, and it's affected by things like mortgage rates and how many houses are available. Keep an eye out, and maybe you'll find a better deal in the coming years. Car prices have been climbing steadily since 2012, and it's making people wonder when they'll finally catch a break. These days, the average new car payment will set you back a hefty $729 a month. And let's face it, not everyone's swimming in cash.
Start with the second part first. I mean, in general, the conversation 3 to 4 months ago was the R word. It was recessions. You heard this in analyst note after analyst note. You heard this from CEO after CEO.
But hey, here's a glimmer of hope. The good news is that prices are starting to ease up a bit. Recent reports show they're about 6% less than a year ago. According to UBS, there's a surplus of cars flooding the market, with global car production expected to surpass sales by a whopping 6% this year. That means we're looking at about 5 million extra cars that need to find new homes. And to make that happen, prices will have to come down. By the end of 2023 or early 2024, we can expect these prices to take a dip. Take Tesla, for example. In September, they slashed prices on several of their models. A brand new Model X that used to cost a whopping $120,000 in January is now a cool $40,000 less. The Model S saw a similar drop, going from $104,000 to $75,000. That's a significant markdown. And here's some more good news. A report from August showed that the prices of electric vehicles, EVs, dipped by about 19% from June of last year, indicating a trend of stabilization. EVs are becoming a more affordable option for those looking to go green on the road. With prices starting to soften, it's a prime time to snag a sweet deal on a new ride. Keep your eyes peeled for discounts and promotions at dealerships near you. If you've been holding off on that car purchase, the road ahead might just be smoother and more budget-friendly. So basically, car prices have been riding a roller coaster, but the tracks are leveling out. All right, let's break down the recent Federal Reserve meeting and what's happening in the financial world. The Fed, in their most recent meeting, decided to hit the brakes on raising interest rates, at least for this month. They want to wait and see just how bad inflation might get before making any moves. The next big meeting to mark on your calendar is on November 1st. At that point, they might think about a 25 base point hike. One significant concern is housing, which holds a high spot on the index. The Fed predicts a drop in housing in the coming months. Why? Well, new leases are being priced at current, more affordable rates. This is a change we haven't seen in years. The chief economist at Realtor.com believes the era of rental-driven inflation might be behind us, although the clear trend may not show until next year. What's interesting is that the Fed seems to be preparing for this shift in the housing market. They might not keep hiking rates as aggressively as before. In fact, we could be closer to the end of rate hikes sooner than we think, assuming no major unexpected events. However, it's crucial to note that they won't be lowering interest rates anytime soon, perhaps not until the latter part of next year. Inflation, as we've learned from historical analysis and market experts like Michael Burry, tends to linger and takes its time to stabilize. It can cycle back even after a period of seeming stability, like a boomerang. The White House conducted an analysis of inflation post-World War and discovered that it took quite a while before the economy could stabilize. So, because of this, inflation and rate hikes could continue to the middle of next year. Given the market's unpredictability with its constant ups and downs, here's a thought. Consider dollar cost averaging into the market. It's a safer approach that could bring in good rewards, regardless of what the Federal Reserve indicates. Stay informed, keep an eye on those meetings, and think strategically in these uncertain times. What I'm saying in essence is that the Federal Reserve is taking a cautious approach due to inflation concerns, especially regarding housing. There's a likelihood of a rate hike in November, but a more relaxed stance could be on the horizon. Despite this, rates won't be going down anytime soon, and inflation might continue to impact the market until the middle of next year. Inflation and the possibility of rate hikes could stretch into the middle of next year, causing uncertainty in the market with its consistent fluctuations. Given this unpredictability, my personal suggestion would be to consider dollar cost averaging into the market. It's a method where you invest a fixed amount of money in the market at regular intervals, regardless of the price of the investment. This strategy can help reduce the impact of market volatility and potentially lead to higher returns over time. Your thoughts and comments on this matter are genuinely valued. Understanding the financial landscape and making informed decisions is vital, and hearing different perspectives enriches the discussion. Feel free to share your insights or ask any further questions you may have. Let's navigate this financial journey together.